On the 29th of January, 2024, a Hong Kong judge ordered the liquidation of a company that owed more than $300 billion. The petition in front of her was worth about $110 million, roughly 1/30th of 1% of what the company owed. In a winding-up court, the size of the claim is irrelevant. Only the proven inability to pay it is. China Evergrande Group was not a property developer that borrowed too much. It was a float, a machine that collected cash from people who were never treated as lenders, and spent it years before it delivered anything. This is how that float ran, the exact policy date it froze, and why the people holding the bonds were standing at the back of a queue they did not know existed. At its peak in 2017, Evergrande ran roughly 1,300 projects across more than 280 cities, with over 200,000 direct employees. The shares traded at 31 Hong Kong dollars and 39 cents, a market value near 51 billion US dollars. Its founder, Cayman, was the richest man in Asia, worth somewhere between $42 and $45 billion depending on whose list you read. Start by correcting the number everybody repeats. $300 billion, later 340, is total liabilities, not debt. Money actually owed to banks and bondholders was in the region of 600 billion yuan, under a third of that headline. The remainder was owed to contractors and to households, and that gap is not a footnote. It is the business model. Chinese law allowed developers to sell apartments before building them. A buyer put down 20 to 30%, took a mortgage, and began repaying the bank before a foundation was poured, because the bank remitted the full purchase price at contract, not at delivery. So Evergrande collected essentially all of the revenue on day one, and incurred the construction cost over the following 2 to 3 years, and that money sat on the balance sheet as contract liabilities. No interest, no maturity date, no covenant, no acceleration clause, and no lender of last resort. The second float was the supply chain. Evergrande paid contractors with commercial acceptance bills, IOUs rather than cash, with bills payable of 205 billion yuan at the end of 2020, up more than a quarter in a year, and roughly 246 billion yuan of them overdue by 2023. The third float was retail, about 40 billion yuan of in-house wealth management products, held by more than 70,000 people, many of them Evergrande's own employees and their families. On the visible side of the ledger, leverage was managed rather than reduced. Perpetual securities were booked as equity while being serviced like debt, and interest was capitalized into properties under development instead of expensed, roughly 170 billion yuan across 2017 to 2020, according to Caixin's reconstruction of the accounts. Borrowing cost, in other words, entered the books as an asset. Then the largest hidden liability of all. Between 2016 and 2017, Evergrande raised 130 billion yuan from strategic investors with a buyback clause attached. If a planned Shenzhen listing was not approved by the 31st of January, 2021, the money had to be repaid at original cost. That is a written put on your own equity, struck at par, with a hard expiry, and it appeared nowhere as debt. One more tell. When Evergrande issued $1.8 billion of offshore notes in 2018, Caixin reported that Hui personally bought around $1 billion of them through an offshore vehicle, the bulk of the 2 highest coupon tranches. Read that the way a trader would. From 2018 onward, there was no genuine external clearing price for Evergrande credit, because the controlling shareholder was the bid. August 2020. The central bank and the housing ministry imposed the 3 red lines: liabilities to assets excluding advance receipts below 70%, net gearing below 100%, and cash covering short-term debt at least 1-to-1. Evergrande breached all three. Note the exclusion in the first line, excluding advance receipts. The regulator deliberately stripped the presale float out before measuring leverage, because Beijing understood exactly what that float was. Breaching all three put Evergrande in the red tier, where permitted growth in interest-bearing debt is zero. And zero is not expensive money. Zero converts a rollover market into a strict amortization schedule. From there, the loop is mechanical and it runs one direction only. Every maturing bond and bank loan now had to be repaid out of operating cash, and the only operating cash of size was new presales, which required new land and construction spending that competed with the repayments. Bills went unpaid, contractors stopped working, construction visibly halted, and buyers stopped signing. A float that stops growing is a run. Then the cash itself became unreachable. Presale proceeds sit in municipally supervised escrow accounts that typically capture between 50 and 70% of receipts, and through 2021, local governments tightened withdrawals to protect their own projects. Consolidated group cash was real and legally trapped at project level. The accounts said there was money. There was no money the parent could touch. September 2021. The wealth products stop paying and investors protest outside the Shenzhen headquarters. The crisis becomes a public order problem and therefore a political one. On the 23rd, Evergrande misses $83.5 million of offshore coupon. Global markets have a brief risk-off week and then retrace. On the 3rd of December, Evergrande disclosed it might be unable to meet a $260 million guarantee obligation on an offshore joint venture note that public bondholders had never had in their models. The Guangdong government summoned Hui that same evening and installed a working group inside the company. Note what Beijing did. It took operational control, and it did not inject liquidity. The objective was delivery of the pre-sold homes, not payment of the creditors. On the 6th of December, the grace period lapsed on $82.5 million of coupons. On the 9th, Fitch cut Evergrande to restricted default. Evergrande itself never announced anything. Fitch asked whether the coupons had been paid, received no answer, and assumed they had not. The largest default in Chinese corporate history was recorded by inference. In July 2022, the loop closed. Buyers at stalled projects across the country simply stopped servicing mortgages on homes that did not exist. Hundreds of projects, spread across more than 100 cities. The credit risk embedded in that presale contract, which had been sitting silently with households, was now pushed back onto the banking system. That is the point at which Beijing had no choice. This was not a layman moment, and the distinction is mechanical, not semantic. There was no derivatives amplifier, no repo chain, no dealer warehousing net protection, no gamma feedback. The losses traveled through index-driven forced selling in the offshore high-yield market and through the real economy in land sales, contractors, local government revenue, and household balance sheets. The losses were enormous, and the plumbing stayed intact. That is the opposite failure mode from 2008. Now the human ledger. Since the 2009 listing, Forbes calculated that Hui Cayman took roughly $8 billion out of Evergrande in cash dividends paid in every year but one, while total liabilities rose in every year without exception. In November 2021, he injected about $1 billion of personal money back into the company. $8 billion out, $1 billion back. In March 2024, China's securities regulator explained where those profits had come from. Evergrande's onshore unit had inflated revenue by 214 billion yuan in 2019, about half of what it reported, and by 350 billion yuan in 2020, roughly 79% of the reported figure. Around $78 billion of revenue that did not exist, with bonds issued on the strength of it. The method matters more than the size. Revenue was recognized on pre-sold apartments before they were delivered, which is the float, run through the income statement instead of the balance sheet, meaning the fraud and the business model were the same act. Hui was fined 47 million yuan and banned from China's securities market for life. The onshore unit was fined about 4.2 billion yuan for fraudulent bond issuance. And in September 2024, the auditor's mainland arm was fined 441 million yuan and suspended for 6 months. Back to the 29th of January, 2024. After roughly 18 months of adjournments, Justice Linda Chan wound the company up on grounds that were procedural rather than moral, no viable restructuring proposal, and an insolvent company. The petitioner was not a bondholder. It was a disappointed pre-IPO investor owed 862.5 million Hong Kong dollars. The offshore bondholder group only joined the petition at the very end. Here is why the bondholders were never going to be paid. The offshore notes were issued by a Cayman incorporated holding company whose only assets were shares in Chinese subsidiaries. And because mainland law restricted onshore guarantees, the market accepted keep-well deeds, an undertaking to keep the issuer solvent, expressly not a guarantee. Around 90% of the assets were onshore and largely pledged already to domestic banks, trust lenders, bill holders, tax authorities, and construction liens, and behind them, as state policy, the home buyers. Deloitte modeled recovery in liquidation at 3.4%. 4 years on, claims filed against the holding company have reached about $45 billion, against recoveries of $255 million, of which only $167 million is traceable back to Evergrande. That is around half of 1%, and it is not a final number. The shares last traded at 16.3 Hong Kong cents and were delisted in August 2025, 16 years after listing. In April 2026, Hui pleaded guilty in a Shenzhen court to charges including fundraising fraud and embezzlement, and judgment has not yet been handed down. China is now shifting towards selling completed homes rather than pre-sold ones, and the 3 red lines were quietly softened once the reckoning arrived. The reform removes the float, and with it the economics that made Chinese development work at all. What transfers is this? A liability that pays no interest and has no maturity is still a liability, and it is the most dangerous kind, because no covenant will ever warn you, and cash on a consolidated balance sheet is not cash. The offshore bondholders were right about the credit and still lost almost everything, because they held a claim on a Cayman Shell against assets already promised to someone else. Being right about the company is worthless if you are wrong about the box. This is analysis, not financial advice.